It's been a crazy market, and the FOMC and the China-US trade deal, everything has been moving the markets all over the place. I brought in Jim Welsh from Macro Tides to talk all about this, and well, let's bring him in right now. Jim, it's been a crazy market, and what did you make of all of it? I mean, we've seen a lot of volatility. Where are you
Yeah.
at?
Well, we're seeing again the continued strength in AI related stocks, and they've become a significant portion of the S&P. So as those stocks kind of go, the market goes with it. What we saw this week were a couple days when the S&P made new all-time highs, but there were more stocks down than up. But again, the S&P was able to do that because of the concentration and performance of those stocks. The Fed met, they cut rates as expected. My view has been that the Fed would cut this time, but that the December cut is less certain. And Chair Powell in his comments and his opening statement, importantly, supported that view. And we've seen, gold get hit and begin to have some kind of a bounce.
Okay, so I didn't catch in the opening statement. I mean, obviously, and let me just show it because everybody should
Yeah,
see
it's the
this
first thing.
comment. I'll just go to
Yeah,
the very first comment. Um, when he said it's not a foregone conclusion, far from it. At that moment, the equity market started to sell off. But
yeah,
I wanted to. But what did you hear in his opening statement that got your attention?
yeah. Well, this was in the opening statement.
Okay,
All right. So that adds premeditation, to the whole process.
got it.
And, after the last meeting, we talked at least one or two different times about what happened with the September summary of economic projections. You had nine people who supported one more cut, and two of those nine didn't support any more cuts. And then, of course, you had nine people supporting two cuts and one guy supporting, Marin, big cuts. So
Yeah.
what did we see yesterday? There were two dissents. One person saying, no, it was one of the two that said no cuts last month, but he went along with it in September and he dissented, Schmidt from Kansas City. And of course, Marin dissented again because he wanted 50 basis points instead of 25, just like in December. But to me, the word strongly differing views, which to me says the chasm between the two groups isn't small, it's significant, and they're strongly held beliefs. And that, again, was the theme that you and I talked about right after the September meeting.
Sure. All right. Well, let's continue on here because I mean, there's a lot to really kind of go over, especially with the price action that we've seen the last couple of days. And one of the things that, kind of stands out to me, Jim, is it looks like the markets are trading heavy after this China US meeting, almost like the buy the rumor, sell the news type of event. And I'm really interested to see what your
Yeah,
charts that you brought
yeah.
to the table. But
Well,
let's go through
a
some.
quick comment on that. Again, this shows the dominance of AI type stocks. They're weighting in the S&P. So you have Meta is down significantly. It was down 12%, not because they're not spending money on AI and data centers. People are starting to look at it and saying, maybe they're spending too much money. So the weakness in the market is related to the concentration of AI stocks being weaker today on balance. The Russell 2000 just a little bit ago was up on the day. The Russell had been acting poorly the last 2 days prior to this. So again, it just shows how the market is being pushed and pulled by the concentration and focus on AI stocks.
All right. Well, that does make sense. And we got two big companies reporting after the close. I know most of you guys
Yep.
will already see that Amazon and Apple has reported by the time you watch this video, but those are the two big ones that are on the docket tonight.
Yep.
Let's talk about your slide here on import prices. I want to talk about like the tariffs too, and China US situation.
Yeah.
I mean, it doesn't it seem, and I know Bloomberg reported it this morning as well. Doesn't it seem like, we're back at square one and there's kind of a postponement of this escalation and it's kind of a
Yep.
de-escalation and now and Trump, it's kind of like a football. I use the analogy today. It's kind of like football. It's like you have a quarterback throwing like these big deep pass plays, and then it gets the defense all into a zone defense, and then you run the ball and you move the flag markers, you move the
Right.
markers by 10 yards, and he's moving up the field slightly. That's kind of how it feels like to me.
I think that's a good assessment that basically what China and the US have decided to do is pull back from some of the extreme comments, extreme positions. Trump 100% tariffs, China, well, we're not going to send you any more magnets and rare earths. So that those extremes have been pulled back, which of course is a good thing. But to your point, has a long-term, settlement on trade been achieved? No. We're going to be back here again. We just have an extended timeout. None of us knows how long that timeout is going to last.
Well,
So
yeah. So does that mean that these prices are gonna like peak now? I mean, because this is your chart of tariffs. They're taking
yeah,
effect,
yeah,
but
yeah,
are we
yeah.
gonna see it roll over now?
I don't think so. I mean, again, we saw a delayed reaction to tariffs bleeding through, a big inventory build back in February. Companies eating, working through those inventories, companies eating a little bit of what the increased costs. But this chart is basically showing, and this is a point I've raised in my letters, is piggybacking. So we see import prices going up because of tariffs. That's the blue line. Pardon me, the yellow line. What we're also seeing is under the cover of those tariff increases, domestic producers who aren't being impacted by tariffs directly are taking advantage of the higher prices. So my competitor gets stuff from overseas and China and tariffs are hitting it. Well, I'm going to raise my prices too. Well, that means that the impact on inflation is likely to be more long, in my view, more long lasting and maybe a little bit more significant. So the tariff bleed through isn't done yet, would be my conclusion, Blake. But the fact that we're seeing piggybacking by domestic producers, means that the breadth of the tariff inflation isn't just limited to the countries that are importing from overseas. Domestic companies are benefiting because they're choosing to raise price.
Got it. Okay. You brought this chart of the S&P and it looks like it's highly composed of AI stocks. And I mean, we got
Yeah,
Nvidia as a $5 trillion company, or at least
right.
was,
Yeah,
as of
yeah.
yesterday. What are we looking at here?
Well, what this shows is as the AI trade has expanded, initially it was NVIDIA and the mega cap stocks directly involved, but then utility stocks started to run because, well, wait a second, we're going to need a ton of energy for all these data centers and so forth. So in February, March of 2023, these 41 stocks represented 26% of the S&P. They're now up to 47%. So again, you see this concentration in this one area. And in the short term, it has been very positive. I think it will continue to be a positive force. But as I'm writing the November macro tides, my point is that the significance of this sector to the economy and to the stock market has reached levels that you better pay attention. I'm trying to remember that old saying, a watched pot never boils or something like that. So my point is, at some point in time, this stuff is going to reverse. The expectations aren't that are very high today aren't going to be realized. That's going to cause some real disappointment. And at some point in time, you might actually see a more significant level of disappointment uh, when the amount of spending really slows. That's going to happen, in my view, sometime next year. So my point is, in the near term, this has been a positive, and I think it's going to continue for a while. But it's why I'm going to continue to monitor it because when the reversal comes, it's going to have a significant impact. And the next chart kind of explores that a little bit more. This shows that since March of 2023, the S&P has gained $32.5 trillion. Of that, 70% is related to those 41 stocks. So it just shows how, if you will, imbalanced the market has become and so dependent on this small group of stocks. All good things come to an end. This is a good thing right now, and I think will likely continue to be a good thing. But at some point in time, tides turn. And that's why, in my mind, it's important to pay attention to this stuff, is to be looking out ahead. Well, what are the risks down the road? Well, the risk down the road is this stuff suffers a meaningful retracement. Remember in 2022, the mega cap stocks got hit harder than the S&P by a fair amount because of higher interest rates, and
Yeah.
they were overvalued prior to that decline. So again, this is just sort of say, hey, folks, let's keep our eyes open. This is great stuff now, but it's not always going to stay that way.
All right. Well, what I'm interested to see if it's peaked or not is gold. So, what's your read of gold here?
Well, for weeks, my expectation was, hey, we're completing a wave five of wave three. They have a tendency to spike. Gold certainly spiked once it got above that green trend line. For 3, 4 weeks, it ran from over 3,800 to almost 4,400. There was a key reversal on October 17th. And then subsequently, we've seen gold shave almost $500 from its high. So my take, Blake, is this is the beginning of wave four from the low at 1,046 in 2015. So
Hmm.
what it says is, all right, this is going to be a lengthy correction, but ultimately, I believe it will be followed by a rally to even higher highs. But in the near term, very short term, gold got somewhat oversold. My expectation in Monday's WTR was, hey, we're about to have a rally. And some of the targets, as I mentioned, the bounce target of 41.34 is retracing 50% of the $494 decline. And the 618 is 41.92. I think those numbers are possible because the bullish sentiment is so ingrained that a lot of people are going to look at this as like, gosh, I missed some of that. I want to be part of the next move. If the analysis is correct, this wave four is going to last months. I think it's going to be very, very choppy. And after the peak in April, we saw a very hard break, and then we saw a lot of choppiness for months. I think that we're going to see more volatility near term with some swings. Then I think we're going to settle down. Target wise, if this is wave four, it will retrace some proportion of the wave three rally, which was set 2,765 bucks. The most shallow retracement would be 37.28. I think a more likely retracement is 33.26 or something near there, because look at the trading pattern after the S&P, or pardon me, gold peaked in April. We went through an extended choppy period. So I think something similar like that is likely after some additional near-term volatility.
All right. Okay. Well, that's fair enough. I mean, with gold does look, I mean, it's having a decent day today, but it does look vulnerable,
Yeah,
at least near term. Speaking of near term, here's your S&P. This is a 2-hour chart. So why
yeah,
is this
yeah.
such a big
Well,
deal?
last week I said, you know what? I think we're going to have a dip. That's why that red line going down to 65.51 and then a rally to new highs. I said, or if the S&P gets above 67.72, we're not going down, and instead the S&P will rally to 68.50 to 6,900, and we got to 69.20. So, to me, again, this is the benefit of technical analysis of where am I wrong? I was looking for a pullback, um, but I was wrong at 67.72, and that was the perfect signal, if you will, to say, all right, now we're going higher.
Stop and
And
reverse. Okay. So
yeah,
you're looking a little bit more intraday. This is a 30
yes.
minute chart.
Yeah, I've never shown this chart. Blake, the top panel is ticks. So I use a number of different moving average of ticks. And ticks are, if a stock goes from 20 to 20 and a quarter, that's a positive tick. And likewise, if it goes from 20 to 1975, that's a negative tick. And so every few seconds, they calculate how many ticks are up, how many ticks are down, and they come up with a net number. This is a moving average. In the unbelievably subdued market we've seen since April, where there hasn't been anything more than a 3% correction going back, I don't know, 130 days, which is like the third most in history. This tick chart indicates short-term oversold. So, if you go back to the left, you see as the S&P spiked down to 65.51, that black horizontal line, well, really oversold. But since then, the green horizontal line in the middle has pretty much nailed each of the lows. So now we're below that as of about a half hour ago when I put this chart together. I think there's still the potential near term that there'll be another leg lower here. But my conclusion here is looking for a big decline is unlikely, given that on a near-term basis, we're already oversold. If it drops a little bit more, it'll start reaching levels that it did not that long ago. And there has to be a reason to sell. So this methodology or this approach is great in an environment where you really don't have significant reasons to sell. When you get into an environment where there are significant reasons, you get down below that black line and the bounces are hard and sharp, and then there's another leg lower. So this is one of those indicators which, has been working and performing really well. At some point in time, it's going to stop working. The parameters are going to change. So again, what this is suggesting to me is we're groping for another near-term trading low. We could see the S&P take out the low from this morning, which wouldn't surprise me. And if it does, the ticks are going to get closer to the black horizontal line. And then just as a filter, the 5 and 13 exponential moving averages, so you get this low reading. And as you saw going back just about a week or so ago when the S&P traded, 66.55, you can see we made the low and then the red crossed the green line and kind of smooth sailing up until yesterday when, Powell said those words.
Yeah.
So, to me, as a short-term indicator, this is suggesting that we're not too far from a trading low and which will be confirmed if and when the 5 crosses above the red. Now, if you go all the way back to the far left, S&P hit 6,700. We got a bounce, rolled over, and then October 10th, that's what that is. When we got, Trump 100% tariffs or whatever, market got hammered. So again, that 5 and 13 moving average is an important component to this. So,
All right. Well, Jim, I have all these, dreams that we're going to be filling these gaps down here, but it doesn't seem like you feel that way. So, we'll see. All right. Yeah,
eventually, yes.
yeah. All right. Well, let's talk about the dollar. The dollar has made a bit of a recovery today. So do you think we can build on this?
Yeah, but again, what we've seen is what I would call, a saucer bottom or bottoming, building a base.
Yeah.
But, we haven't completed it because we haven't taken out 100.25. So to me, that's what's necessary. The fact that the potential for a December rate cut was taken off the table to a large extent by Powell. Again, they're data dependent, meeting by meeting, all that happy stuff. But Wall Street was like 90% certain that a cut was coming in December. I think it's down to the low 60s now. But for the dollar, we need to get above the 100.25. Then that'll start to look like, wow, we've actually completed something. That recent low, I was closer to 9,800 as opposed to the 97.46. But once we break out, we shouldn't come down below those numbers. Yeah, in other words, it breaks out, it should be on its way.
All right. And the last chart you brought is about the treasuries, and we saw
Yep.
we saw the ZNs or the 10-year today break through a channel support. So that
Yep.
means yields should be going up, and it looks like
Yep.
based on your chart, they are.
Yeah. Yeah. Again, what I've noted here in September when the Fed cut, what did the 10-year do? It went up. We're seeing a replay of that. The other thing that's happening, Blake, is that the Fed is going to stop running off its treasury debt, December 1st. But it's going to continue to allow mortgage-backed securities to roll off up to 35 billion a month. When the proceeds comes into the Fed, rather than buying treasuries or buying additional mortgage-backed securities, the Fed's going to buy T-bills. So that means more and more of the funding is going to be short-term. And so the balance is going to shift in terms of the Fed's balance sheet. The maturity midpoint is going to become shorter because they're going to shift more and more buying into treasury bills. And the treasury is obviously going to accommodate them by selling a lot more treasury bills. So we've seen 50 basis points cut in the Fed funds rate in September and yesterday, and yet the 2-year is higher and the 10-year is higher. So the bond market's reacting to the shift underneath the surface of Fed focusing on buying treasury bills. We're still running a huge deficit, and inflation isn't anywhere near the Fed's target and so forth. So to me, there's a lot of things going on here. I thought there was a potential that the 10-year could come down and get near that green horizontal trend line around 387 underneath the market. That's what I said last week. But taking out that red trend line, which I noted in the weekly technical review on Monday, above 409, then all of a sudden that cancels the probability of it getting down to that 386 and instead implies we're going to go back up and do another test of the 420. Breaking above 420, then I think the treasury yields, will move more maybe aggressively to the upside.
Well, maybe that's what the
So,
dollar needs for the dollar to break out, Jim. So,
not going to hurt it.
yeah, yeah.
You know,
So it's been a real interesting market, and I'm gonna defer to you guys at home. For those of you, if there's an asset class that you want Jim to take a look at, jump down in the comments below. Let Jim know, and he'll try to tackle that this next week. Maybe something that's
yeah.
moving that you think that he should look at. Jim, I want to thank you for
I do
guiding
look at
us.
things like Bitcoin. It's
Yeah,
just that I try to limit hey, we're trying to keep these things under 30 minutes.
yeah.
And there's only so much we can cover because we're talking about the economy. We talk monetary policy, sometimes global stuff, and then we cover a lot of technical. So, but I think that's a great suggestion. I'll be
Yeah.
happy to respond to any requests that you get.
Soybeans it is. Soybeans it is. All right. Jim, I want to thank you for guiding us this week as you do every week. And how do traders get your information, like your technical review this week? How can somebody get their hands on
Send
that?
an email to jimwelshmacro@gmail. I'm happy to send that out to you.
All right, and then make sure you let them know you did come from Trader Summit and you saw us here
Yep.
on our show, and Jim will happily give you a discount if you want to get a subscription of his. So,
Yep.
Jim, have a great weekend, and I'm sure it's going to be beautiful weather in Southern California. So enjoy that, and for all of our viewers at home, if you can give Jim a big thumbs up, jump down in the comments, let us know what you want to see, and then also subscribe to the channel. It's free to subscribe to this YouTube channel. Subscribe to the channel so you don't miss this exclusive content with Jim. So Jim, have a great week,
Happy
and thank you so
Halloween.
much. Happy Halloween. Happy spooky Halloween. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.